Welcome everyone. We've got a record attendance today, so thank you very much for giving us your time. My name is Nathan Bell. I'm the Head of Research here at Peters MacGregor, and today I'm joined by our Chief Investment Officer and Founder, Wayne Peters. Welcome, Wayne.
Good morning, Nathan.
I just need to show you the disclaimer, but obviously you'll be able to download this off the website later as well when we put up the presentation. So in terms of performance, it's the end of financial year, so it's always a good time to look back at the year that was, essentially in line with the index, a strong absolute return around 15%, which I think we'd probably be pretty happy to get that every year for the rest of our lives, particularly in a low interest rate environment. But considering the cash weighting we had and a slight headwind from the Aussie dollar, the stronger Aussie dollar, it's a solid result. The cash has actually come down to around 18 or 17% since the end of June, as we're actually finding we've actually been quite busy and found a number of opportunities away from America, which is we still own a lot of US listed stocks, but the value is actually appearing elsewhere, and we're going to take you through some of those stocks today. So just in terms of our top 10 holdings, there's not a lot of change there. You'll see number 3 there on the list is Fairfax India. It's our first Indian stock, which ironically is listed in Toronto in Canada of all places, and I'll get Wayne to take you through the opportunity there shortly. Just wanted to make a point because we're at a situation now where central banks around the world are changing their interest rate policy. So we've basically just had a decade or so of lower interest rates, and for the first time in a very long time, we're going to have to start dealing with higher interest rates. Now, we don't necessarily think interest rates are going to go back up to the old levels because there's too much debt in the system to handle that anyway, and it will just basically collapse the economies, and no politician or central bank wants to be in charge when that happens. So it'll be very gradual. The quantitative easing will be gradual, but I do expect we're going to see more volatility. And the reason I wanted to point out these particular companies, which we're going to talk about today, is just to remind you that the quality of the companies we're buying are absolutely best of breed. Usually there's the type of businesses that you can't find in Australia, but they're very well run, and they've got long track records, and they are the highest quality business we can find, cognizant of the value they're offering. And the reason I mention that is because when we get to these periods where it's much more volatile and people start to question what they own, and I think sometimes they look at their foreign stocks or foreign businesses and they aren't as familiar with them as what they are with their Australian companies they've probably followed for a long time, and often it's tempting to sell those stocks first. So again, the point I wanted to make was these are absolutely wonderful businesses, and in terms of putting a portfolio of these businesses together, you don't really have to worry that they're going to lose a lot of money over a long period of time. We can't say that on an individual stock basis. It's a bit like what Peter Lynch used to say: I'll give you 5 stocks that I know as a portfolio will do great, but I can't tell you which is the one that's going to do brilliantly, the 3 that will do okay, and the one that doesn't work out. But these are absolutely wonderful businesses, and part of the reason we have these webinars is to try and explain to you why we actually think these are excellent businesses and worthy of your money. So just quickly on the interest rate cycle, obviously the macro isn't something we spend a lot of time talking about. We know from history if you buy the right businesses, they tend to get through the macro problems easily, and hopefully they actually come out much stronger vis-a-vis their competitors. But we are in a different situation at the moment where basically everyone went into the GFC and everyone suffered, even though sort of China was very helpful to Australia and Canada in particular. So we didn't have the giant recession that Europe and America and other places had. But the way interest rates are going to go up from here is going to impact different geographies differently. And so if I look at Australia and Canada, which have huge amounts of debt, a very leveraged housing market, these are the areas that are going to be very sensitive to higher interest rates. And obviously we're global investors, so we don't invest in Australia anyway, but we're trying to position the portfolio to actually take advantage of higher interest rates rather than just be roadkill. So I'm going to talk about European banks in the moment, which I actually think are the safest to invest in probably 12 or 13 years, and higher interest rates would actually be good for those companies as opposed to what we might think in Australia or Canada. So our banking portfolio has changed somewhat. 2 years ago, we were much heavier in US banks, but they've largely played out. We've now seen higher interest rates baked into those valuations, and now we have a much higher exposure to European banks. So I just want to give you one example. Mediobanca is a company there, you can see with the Italian flag. It is an Italian bank, and if you've been looking at the headlines recently coming from Italy, you probably wonder why on earth we're buying Italian banks. And so there was a couple of banks about 3 weeks ago that were euthanized. They were essentially bankrupt. But what happened was, for the first time, this really should have happened 4 years ago, the central bank in Italy came in with a rescue fund. They put in 20 billion euros. And what they managed to do was essentially wind down these two banks. They passed on the good loans to another Italian bank called Intesa Sanpaolo, and they took on a whole bunch of bad debts themselves, which they're going to sell to investors, so fixed income investors at cents on the dollar, the euro dollar. And depositors still managed to keep their money through this process, and there were absolutely no ripples through the financial system. So this was a very orderly wind down. And what it means is that the banks that are left now have a much more a higher market share, and the stronger banks are the ones that are going to be left once we work through this situation. So we've seen the US banks get cleaned up, and now we're finally seeing it in Italy, where the bad debts are coming down, earnings are going up, and eventually we think it's going to be the same situation as what happened in America, and that is when interest rates finally start going up in Europe, which we expect will be in the next 12 to 24 months. Then you'll start to see the market price these financial institutions in the same way that they price the US banks. But it's just going to take the market to see interest rates going up before they're finally going to act. But we know from history that we actually want to be there before that happens, because that's how you make the money. You've still got to have that contrarian nature about your investments. So Mediobanca never raised capital during the GFC, which I find remarkable. Pays a 3% dividend. It's the Macquarie Group of Italy. It's very profitable. We bought it at 0.8 times tangible book value. And even if profits don't go up a lot, just if interest rates start to go up, we think this is probably more likely to be priced at 1.1 or 1.2 times tangible book value, which would more adequately reflect its quality. And we're getting a 3% dividend along the way, so that's quite helpful. So that's essentially the European, or particularly the Italian background. So it's not all doom and gloom like the headlines suggest. But we've got another bank here, and this one's called Metro Bank, and this is very different to the banks we've been buying since the GFC. So this isn't a large bank that's in a recovery as such. This is actually a fairly new bank, particularly by UK standards. But I'm going to hand it over to Wayne to address the investment opportunity.
Yes, Metro is a very exciting addition to the portfolio. It's a bank that was founded by Vernon Hill, who previously built and ran a Northeast US company called Commerce Bank. And this is pretty much the same game plan. He's come into a market which has been characterized by very old, established, almost monopoly-style banks that have not focused on customer service. The customer service in the UK is even worse than the experience that you have as a bank customer here in Australia, and that's saying something. Just as one example, to open a bank account in any of the four major banks there requires an appointment, which can take days, if not weeks. And then once you have the appointment, it takes about 2 to 3 weeks to obtain the bank account opened. With Metro, you can walk in and within 45 minutes, you'll have your account opened and you're on your way. So that's just a classic example of the difference and the customer service that Metro is offering. What we like about this business, it's been now running for 7 years, so we're not making any giant leaps and assumptions on what it can do, because we've seen what it's achieved already in the first 7 years. But to give you an indication of how staid the UK banking market is, Metro was the first bank to obtain a banking license in over 150 years. Can you believe that? It's quite amazing. And the other banks are still asleep at the wheel compared to the customer service levels that Metro are offering. And it's no wonder that their customer acquisition and deposit growth is as stellar as they have been over the last 7 years. So this is the bank on its way to having 100 billion in deposits, 100 billion pounds in deposits by 2027. And even then, that'll only be about a 4% market share. So if they achieve that, we will triple to quadruple our money over that period. I had the opportunity to meet with Vernon Hill, the chairman, and Craig Donaldson, the CEO, who's only 46. And together they've built this business now to a business that's scoring the highest on any customer service surveys across retail. So not just across the banking industry, but across retail. It's very, very customer centric. The stores are bright, they're fresh, but underlying the business strategy is their software and operating systems, which are first in class and leave their opposition in the dust. The issue the four large banks have is to write off that infrastructure cost in software would be a very big expense. And at this stage, they're just not viewing Metro as a threat. So we believe Metro will have many years of compound growth in both customer and deposits, and we expect to see the value out of investment grow very, very strongly there. So this bank really ticks all the boxes in the quality of the business, the runway that's in front of us, and the quality of the management that have a large amount of their own skin in the game.
So you can actually walk into this bank and walk out with printed cards after opening a new account within 45 minutes. And one of the reasons they can do that is because the technology they're using is just nice and clean. They only just have the one bank. It's up-to-date technology. It's essentially off the shelf. And basically the bank runs online, whereas you compare that to some of our existing holdings or past holdings like the Royal Bank of Scotland or Lloyds that do things with batch processing. And so you can actually, will normally have to wait weeks to get your cards. And that's why, as Wayne said, you had to take an appointment and come back in a couple of days sometimes just to get the process started. So this is a pretty exciting opportunity, but we've seen this happen in the past. Commerce Bank, I think, had a 3-decade annual shareholder return of 23%. So this is really, in a sense, it's not a new technology or disruptor in the true sense, but it's actually disrupting the market with something that's as old as the hills, and that is genuine customer service. We've got 7 years of track record already, and all this business needs to do is continue to offer that great service and roll out new stores, and we should do very well over time. So our Chinese technology stocks, Baidu and JD, we've talked about in the past. So JD is a bit like the Amazon of China. It's doing exceptionally well. It recently had a day sale to celebrate, I think it's the 10-year anniversary of the company, and the sales were just off the charts. We can give you lots of other anecdotes about this business, growing very quickly, and although it's been contributed, I think, about 60% return since we've owned it in just over a year, that's really just scratching the surface. This really is a business we want to own for the next decade, and it's doing all the right things. It's investing for the future. It has what we believe is an unassailable lead in delivery. And I was just watching a video this morning of drones that they're testing, and they actually want to be able to send these drones up to distances of 500 kilometres to get to rural areas in China. So it's amazing what they're doing, but it's run by a very intelligent founder who's doing all the right things, and can't speak highly enough of that at the moment, but it is going to be a volatile ride. So Baidu is not doing anywhere near as well as JD. We bought this business when it was under a cloud. There's a regulatory clampdown on medical advertising, and we haven't seen the growth return to that business yet. We should find out in the next 6 to 12 months whether that's going to return, but there's also a number of other attributes as to why we like Baidu, including a heap of cash on the balance sheet. But the one we want to talk in a little bit of detail today is Tencent. For most people, it's most likely the $350 billion company that you've never heard of. It's run by a guy called Pony Ma, and it's most well known for its WeChat mobile messenger service, which is a free service, and it has 938 million monthly active users. So it absolutely dominates online, I guess, mobile communication in China. The way to think about Tencent's app, though, is to think of it as like Facebook, PayPal, Uber, Yelp, and Expedia all rolled into one. It's almost like the internet within the internet. And again, it's just when you've got 938 million people on there, and half of those spending up to 1.5 or 2 hours a day on there, it just tells you how much value there is in this business, even if it's not necessarily showing up in earnings. But unlike JD, which is still investing very heavily for the future, and so a lot of that's not hitting the bottom line yet, Tencent actually is very profitable already. It has a 50% market share of the Chinese gaming market. It's exceptionally profitable. It's a very high margin revenue, and quite remarkably, for Facebook in the West, I think it's anywhere, depending on which country you're in, between 30 and 50 ads you will receive per day. Now, in China, Tencent, on what they call moments, it's only one ad, I think, per person per day. So it just tells you how little advertising you're actually putting on people and how big the opportunity is. And again, it hasn't really scratched the surface yet.
Nathan, what's fascinating about it, this business, it has a product, one of its games, where they had to bring in time limitations on which their customers spent on the games. So for children below 13, they've limited to them spending 1 hour a day, and then from 13 to 18, they've limited to 2 hours a day. That's a first-rate problem to have, where your customers are using your product to an extent where you have to limit the time they spend on it. Very proactive, but these are the type of businesses that really interest us.
Yeah, China loves its national champions, so a lot of these technology businesses have next to no competition. We paid 37 times earnings for this business, and that's not really a multiple Ben Graham would have ever been comfortable with. But the way to think about this business is it's not just looking at earnings today, it's about how fast it's growing and what this business can transform into in the future. It has a business there called Tenpay, which is essentially PayPal, and it has a couple of competitors. I can't remember what the amount of revenue or purchases going through that Tenpay was, but it was some astounding amount, and this is still just a fledgling technology. So the fact is this isn't even hitting earnings yet, and again, this could be a huge business. So with revenue growing last year at nearly 50% and expected to do so again, we think over time that 37 times earnings is going to come down quite quickly. So Wayne, you just came back from a trip to India, and ironically we bought our first Indian stock, which happened to be listed in Toronto, Canada. How did this come about?
Well, firstly, we've been watching India for some time, and there's been a lot written about India, with Modi coming in and controlling the government, and the major reform packages that he's introduced really presents a tremendous opportunity. Here's a market with 1.3 billion people, yet the per capita income is still only $600. So a massive market. And interestingly, the only large economy which doesn't have an aging population. So with the reforms that Modi has brought in, like the demonetisation to reduce the corruption and the black market, the introduction of GST to broaden the tax base, at the moment the tax revenue per GDP is only 1/3 that of Australia. And the introduction of a nationwide ID program and housing for all by 2022. There are some amazing policies with very ambitious plans laid out to increase the per capita income per person in India, and finding then businesses that are going to supply that increasing demand is where we're very focused. Of course, with a population that size and in a developing market, corruption is rife, and understanding who is managing your money, who is running the businesses that you're investing in is absolutely paramount. So with that caveat in mind, we went around and we found a number of companies that we're doing a lot of work on, and Fairfax India, interestingly, is the first business we've come across. We've owned Fairfax Financial, the largest property and casualty insurance company in Canada, and through their contacts, we've met the management of these businesses in India. And on my recent visit to Mumbai, I had time with the CEOs of each of the underlying businesses within the holding company, Fairfax India. There are 8 major investments, but today I'll just touch on 3 to give our investors a flavour for where we have our money. And these are assets that we can't buy directly into. The first is 48% share of the Bangalore International Airport. It's the 3rd largest airport in India. Last year it had 22 million people go through the airport. To give you an idea of the growth rates, by 2030 the numbers are expected to be in excess of 60 million. So a 3-fold increase in just on 12 years. These growth rates you're not going to see anywhere else in the world. just absolutely phenomenal. And the ability to buy into this asset at a discounted price is just a very unique opportunity. The next large position that Fairfax India own is a 30% interest in the second largest PVC company in India called Sanmar. Now, the PVC business on face value, you dismiss saying it's highly cyclical and the margins can move around. But this company has been built by one family since its inception, and it has significant vertical integration aspects from key source materials in Egypt through distribution networks through the broader Indian market. And Fairfax has secured a 30% equity interest through lending the company at a critical time $300 million through a bond issue. So for us, this is the one asset which is severely undervalued in the NTA calculation. That's why we believe the value for this business is significantly above the stated NTA. And then the third company, to give you a bit more flavour, is a 27% interest in the financial services company IIFL. It offers us financial planning, wealth management products to a middle class which has growth prospects unlike anything we've seen pretty much outside of China anywhere. And the numbers are almost mind-boggling. So our game plan with India are to find these high-quality businesses with top management that you can trust and will see that the shareholders are looked after, that have extraordinary runways. So we're very excited about India and the prospects that we'll likely find there in years to come, and we're specifically excited about the Fairfax India. The stock is already up 15% since we made our entry into it, but the short-term movements in the stock price is not where our focus, and as you know, Nathan, 10 years is our minimum investment time frame, so we have very high expectations of this investment over the coming 10 to 15 years.
Just very quickly, Wayne, just getting away from the stocks for a second, do you want to quickly talk about the Aadhaar biometric database in India, which I actually think is one of the most transformational things happening around the world that's not getting any press?
Well, that's a very good point, Nathan. This national ID system is the leader in the world. And in a very short period of time, Modi has brought about 1.1 billion people into this system. So this is fingerprint and retina scanning ID systems, which automatically reduces doubling up of accounts and fake accounts. So if you want to get rid of corruption and tax evasion within a system, this single undertaking has proven unbelievable. On top of that, with this ID, you're able to open bank accounts. So moving people away from the black market onto cash and tax paying will be transformational for the Indian economy.
So when you combine that with the other policy changes that Modi's introduced, I think the setup in India just generally looks much better than what it actually gets press for. Probably lives in China's shadow a little bit too, I think. So in summary, the key takeaways are that higher interest rates will impact different countries differently. As I've talked about, the European banks, I think, are an area that are going to benefit from higher interest rates. We prefer the Chinese technology stocks over the US technology stocks. They're less mature businesses, but the markets are also bigger over time, and they're just absolutely dominant. Again, we like the European banks better than the US banks, which have already priced in higher interest rates. And Modi's India is a huge opportunity, but again, we still need to be selective. Valuations are actually quite high at the moment in India, but in terms of Fairfax India, we like the valuation, but again, it's not a steady state business. There's going to be a lot of deals that company can do over time, and you need expertise in those countries, and it's great that they're doing the hard work for us. So I should have mentioned that you can put questions into the system throughout the presentation. So if you haven't done that, please do so now. But what sort of questions have we got, Matt? So the first question is, do you see the heated real estate market in China as a threat to economic stability in China and the Asia-Pacific markets overall? So my response to that would be we're actually seeing major policy changes in China to try and manage the debt at the moment, and the debt is gargantuan if you look across the country, but actually at the individual level it's not that high. We're seeing state-owned enterprises now getting backstopped by the government, and they're actually getting these businesses to act like proper corporate businesses that are actually profitable. So it's only slow moves so far, but you're seeing capacity come out slightly from some industries. It's going to take time. But the response I would have, and I think this is the most important aspect of it, because if you just look at the macro statistics and focus on the debt, I guess more specifically, you're going to get quite worried. But we've done two things that we think protect us very well from that. The first thing is we've hedged our Chinese yuan exposure. So if there's a major devaluation, that's not going to hurt us. And the second thing is we own technology stocks, and these aren't cyclical businesses. And the way, if there was a deep recession, then we'd expect our JD, Baidu, and Tencent to behave in the same way that Google and Amazon did through the GFC in the States. And that was the tailwinds blowing behind these businesses were just so strong, it barely slowed them down, and they went on to be terrific investments over the next decade. So, yes, we do worry when we see high debt anywhere, but I think the consequences, if it becomes an issue, it's going to be much more consequential for Australia than it is anywhere else. The fact is, the marginal buyer in Australia's property markets is Chinese. Our biggest export partner is Chinese. And we've really got through the GFC because of that massive spending or credit binge that China's been on. So if you're going to worry about the macro, I'd be much more worried about what it means for Australian assets and the Australian currency than what it does for the Chinese stocks that we own.
Okay, I'll take the second question in here. Any lessons from Berkshire Hathaway investments for stock picking elsewhere? I might just open by saying we've had 5 positions in the portfolio over the last number of years in which Berkshire Hathaway has actually followed us into the investment. The first was Bank of America. The second was Precision Cast Parts. In fact, they didn't follow us into the company, they bought the entire company. So we were shareholders in Precision Cast Parts, and then Berkshire made a bid and acquired the business outright. SiriusXM, where they have only recently built a position as about the same size as John Malone, so just under 10% of the company they've bought. Our Latin America cable exposure through Liberty Latin America, and our European cable exposure, Liberty Global. So these are businesses you would have seen in our portfolio, and a number of you may note that Berkshire own them as well. But in every instance, Berkshire has bought after we've bought the position. So in some way, that's affirmation that we're fishing in the right ponds. But we certainly don't like getting taken out of a position, even if it's Berkshire, because owning these businesses for the long term would have provided us a much bigger return. On our recent annual visit to the Omaha meeting, and it was my 20th year there this year, so we know quite a few people there. It's a massive networking opportunity over about 4 or 5 days, and the team and I utilised that time very effectively. But the main takeaway, as we get quite often from Buffett and Munger, is don't get sidetracked and too focused on the macro. Focus on the quality of the businesses you're looking to own them for the long term, and really, that continues to be our motto. We're looking for businesses that will do well irrespective of the economic cycles, will swim well irrespective of the economic tides. So we're looking for the businesses with the strong balance sheets, strong competitive positions that can actually grow their business value through down cycles. And that's really where we continue to be focused.
So the question is, how do you define your process of stock selection? In basic terms, are you value, growth, or intrinsic value investors? Now, the easy response is that we're value investors, but I think what probably looks maybe a bit strange is when you see us paying 37 times earnings for Tencent. But I think the reason this question comes up so much is that one person's definition of a value investor is quite different to someone else's. And the definition that I have is just buying something for less than it's worth. So it doesn't matter whether it's trading at 50 times earnings or 2 times earnings. The question is this business or those future series of cash flows worth more than what it's currently being priced at? And that's the same thing that we apply to no matter where the company is listed, what type of company it is. You might go different ways around actually valuing the business, but it all comes down to the same thing. How much cash is this business going to produce in the future, and are we being compensated for the risk, and are we paying less than what that business is worth? So it's really that simple. So the next question is, what is the current cash position in the portfolio and why? So I'd say at the end of June, I think we had something in around the low 20s, just under 20.
Yeah, 18%.
Yep, and we've actually got one or two stocks that we're looking at the moment. So if it comes to, who knows what's going to happen over the next 3 months, but it may be down to 15% or less. But I've just come back to the point I tried to make with the banks, and that is we don't see, across the board the best opportunities currently in America. We're actually finding them in areas where people aren't spending so much time, like a Fairfax India, or the Italian banks, which I think when you even just say those words, it frightens most people. But we've seen right around the world since the GFC that as soon as the country has recapped the banks, then everything's got better afterwards. And we could go through all the reasons why it's taken so long in Italy in particular, but that is now happening, and the value is there, and we feel that it's the safest time to invest in Italian banks probably in 14 years or more, since way back before the GFC. So we're very comfortable about putting that money to work. And again, we're just trying to stay away from the most overvalued parts of the market, which I always pick on McDonald's just because it's easy to talk about, but earnings have not moved since 2009, and yet the price to earnings ratio for that business has gone from 13 to 27. So that's the sort of businesses that are getting picked up in index funds and ETFs, and that's the sort of business we want to steer well clear of. It's still a very good business, even though it's not growing, but I just don't know how you make money from a business like that when you're paying that sort of valuation. So the next question is, are the FANG stocks overvalued? So I think you've got to mix up those stocks when you look at them. If we look at Netflix, funnily enough, the stock's up 10% overnight, and yet I saw a headline that said it's spending more cash or losing more money than Tesla. So that probably tells you what we think about Netflix. Alphabet or Google, we argue about a lot. I wouldn't be surprised if we own it at some point in the future, but it's hard to say it's necessarily overvalued. I think it's the one that's probably the most in line, at least with some sort of intrinsic value estimate. Facebook, again, I don't think has, this is my personal view, doesn't have the opportunities that Google has in the future, and it's already, in a sense, maybe not just yet, but is maximising the value of its audience. And I just think Alphabet has a few more irons in the fire of how it can do it in the future. But that said, both are very strong businesses. Hindsight says we should have bought them a long time ago, but we've missed them, and we're still debating Amazon. The crux of Amazon's story is it has a Amazon Web Services or cloud storage business, which is probably at least worth $100 billion or more. It makes plenty of money. The question is, what does Amazon's retail profit margins look like in the future? And also just what does the business look like in the future, because it's changing all the time. And those questions are very hard to work out, and we have lots of debate within the team, and so far we don't own them. But I don't think it's a fait accompli that they're necessarily overvalued, but the question is, do you feel comfortable that they offer a margin of safety? And I think that's an even harder question to answer.
Stuart Pearce in New Zealand asks, how many positions do we own? Currently 22 positions. What percentage does the top 10 position represent? Just on 47%. And what is the largest weight and position? The largest position currently by weight is Libby Latin America, our Latin America cable exposure, and that represents 5.8% of the portfolio, Stuart.
And I would say it's a stock that hasn't worked out for us from our initial prices we paid, but it really is a cast off. It was essentially spun off from its Liberty Global, its parent, and it's been left for dead and traded down to $20 John Malone's recently started buying stock in his personal account, and the stock's up 30% in the last week. So finally, it looks like other people are starting to see the value in that stock. I think that's all the questions. So with that, by all means, if anyone has any further questions or would like to speak to us or Alex, our head of distribution, please give us a call anytime. We're more than happy to take questions. Thanks very much for your time today.
Thank you.